typical Poulos technique. It's good to know. That's you, and it's worked so well for you. Now, a really unique feature of ETFs is what's called a short ETF. Can you tell us what that is and why it's so powerful?
Yeah, a short ETF is nothing more than an ETF that holds only short positions in the underlying securities that the ETF represents. Mm-hmm. So if it's let's say it's a small cap index ETF, there is an ultra short small cap ETF fund that has short positions in the small cap stocks. And that's all it has. It has no long positions. So if we're in a bear market and those small caps are dropping, the value of that ETF is going up. This is powerful because, well, selling short is not all that difficult. It does have attendant risks that buying long do not. Mm-hmm. And you can get around that by just buying the ETF that's holding the short stocks. So you buy the short ETF, you avoid the whatever issues there are around short selling, and you still participate though in benefiting from a down market.
Well, that's slick, and that's slick. It also ties into my next question, which is about IRAs. As you know, most IRAs put really strict limits around how you can trade, what you can trade, especially when it comes to going short. You essentially can't do that. And so when we're in a bear run, you generally have to have your IRA in cash and miss out on any potential short-term bear runs that traders who can go short in other vehicles can take advantage of. So is this where the short ETFs come in to take advantage of that?
Yeah, this is exactly where short ETFs come in for the IRA trader or IRA investor. You don't have to be a trader. There's at least a couple things here that a person with an IRA can do with ETFs. One, of course, as a trader, they can trade in and out of ETFs, including these short ETFs, because otherwise they wouldn't be able to take a short position inside an IRA. And then second, as a lot of IRA investors do, they're always 100% invested on the long side. And so when a bear market hits, they get hammered like we're experiencing right now. And all they can do is sit there and watch the value of their IRA plummet. And so one approach there is to hedge their long positions with a short ETF or two or three, which can dramatically reduce the risk in that IRA. So there's a lot of flexibility there, from trading in and out of IRAs, including short IRAs, to hedging one's portfolio with a good short ETF strategy.
That's great. It sounds like ETFs are the perfect way to supercharge an IRA. And there's so few ways to do it. I guess it's really got to be considered. But what about risk management? I've always liked your attitude about risk management. You've always presented it in a simple and effective way, which is really why I've always gotten behind your courses. I know you normally teach this in your course, but can you share your step-by-step management technique with our listeners, especially as it pertains to ETFs?
Risk management is first and foremost, as you know, the key success factor for a winning trader. If you don't pay attention to risk, you're just simply going to lose. It may take a while, but it's going to happen. So you got to pay attention to risk first and foremost. The second thing I'd say is there's a tendency to overcomplicate risk management. And when you do that, you don't have the discipline to follow it. So simplicity is important. So it's got to be simple, yet it's got to be powerful. And so what I've done is adopt the simple approach where on any given trade you risk no more than 2% of your account size on that trade. And that means the amount of money you would lose if the trade went against you. Mm-hmm. And that way you can always quickly calculate before you put a trade on what that maximum risk level should be. There's nothing difficult about that, and that way it should help to keep you disciplined. Now then, to assess how much risk is in a trade, we have a very specific stop loss strategy where you place the stop, depending on the trading method you're using, you place the stop where you don't expect the market to go. And I say it that way because so many traders place stops where they're going to get hit. They're too tight. They don't give the market enough room to move. And when you do that, you might as well just send a check to the broker because you're going to get hit. So we place stops close enough to protect the position, but where we don't expect the market to go. And if it does go there, the premise of the trade's over and you get out. Right. Now, the other part of that is the exit strategy to exit profitably. We have a two-step strategy. Again, simple is better. And you don't give up effectiveness for simple, but you don't need to be complex either to be effective. So the two-step exit strategy is you exit one half your position at a profit target, a predetermined profit target, usually around 10%. And the second leg, or the second half of your position, you trail the market with a trailing stop as the market moves in your direction. And that way you're on board for as far as that market wants to go and as much as it wants to give you. And so that two-step approach we found is not only extremely effective in getting the most out of every trade opportunity, but it tells you what to do every day you're in a trade. You're never having to guess, and therefore you should have the discipline to stick with it and not try to outsmart yourself when you're trading the market.